Hey guys, welcome back to the channel. I'm Luke, an ACA qualified accountant, and in today's video we're going to discuss how to account for VAT. VAT is definitely one of the more challenging topics that you're going to come across on the accounting fundamentals exam, so I thought it was worthwhile making a video discussing it. So here what we're going to do is we'll briefly introduce and define VAT and discuss what it is, and we'll also run through how to account for it using journal entries, and also we'll look at how to calculate both gross and net VAT. So yeah, let's get into it. Okay, so let's begin with the basics of VAT. VAT stands for value added tax, and it's a consumption tax, meaning it's charged on the final consumption of goods and services that are sold within the UK. The key idea with VAT is that it's not a tax on income, it's not a tax on profit, it's a tax on spending. So every time a product or service is sold, VAT is a tax that's added on top of the final sale price. One thing that's really important to bear in mind when it comes to VAT is that it's the end consumer who actually bears the cost of VAT. i.e. they're the ones who are effectively paying the value added tax. However, it's the businesses in the supply chain who collect that tax and pass it on to HMRC. VAT is collected at every stage of the supply chain, whether it's the manufacturer, the wholesaler, the retailer. If they're VAT registered, they can reclaim any VAT that they've paid on their own purchases. But consumers don't have that option. So in essence, VAT is collected multiple times but only paid once by the final consumer. Say you walk into a shop and you buy a new jacket for £120, that price includes VAT. So you, the customer, are paying tax as part of the total sales price you pay to the shop. The shop will collect that VAT from you and they'll send it to HMRC. But when that same shop bought the jacket from a supplier for say £80, they paid VAT too. But because they're not the end customer in that supply chain, they're able to claim that VAT amount back from HMRC. So the cost of VAT doesn't sit with the supplier, doesn't sit with the manufacturer, it doesn't even sit with the shop that sells the jacket. They don't owe any tax. The tax is completely funded by you, the final customer. That's the key point when it comes to VAT. It's the end consumer who's the one that's bearing the tax. The retailer, the manufacturer, and the supplier that sit in the supply chain just collect that VAT on behalf of HMRC. They don't actually bear that cost. So hopefully this slide gives a helpful visual to back up what I've just said and explain how VAT operates through the supply chain. So as you can see, the product flows from manufacturer to wholesaler to retailer before reaching the end customer who purchases the item they need from the shop. At each step, businesses are adding value, whether by refining the product, distributing it, or marketing it. However, despite the fact that they're adding value at each stage of the process, none of these intermediaries actually bear the cost of VAT. They charge VAT on the price that they sell the product to and to the next party in the supply chain, and they may pay VAT on the purchases that they make, but because they're VAT registered, they can reclaim that VAT that they've incurred. The key point is that it's only when the product reaches the end consumer who can't reclaim VAT that the tax becomes a real cost. It's the end consumer that's bearing the full VAT cost on their purchase. That's the end of the road. So the key takeaway again is that it's the consumer who bears the full cost of VAT. The businesses that come before them in the supply chain act as tax collectors who pass on that VAT that they collect onto HMRC. Let's bring the concept of VAT to life with a worked example. So let's assume a 20% VAT rate with a manufacturer that sells goods to a wholesaler for £1,000 excluding VAT. The wholesaler then sells those goods to a retailer for £1,500, and finally the retailer sells those goods to the end consumer for £2,000. Our task is to work out how much VAT is owed to HMRC, and more importantly, who actually bears that cost out of the four parties that we have on this slide. So let's explore the breakdown on the next slide. The manufacturer charges 20% VAT on their £1,000 sale, so that equals £200. And they collect and pay this amount to HMRC. And since they produce the goods from scratch, there's no VAT for them to reclaim from HMRC. They haven't made any purchases, so the VAT that's reclaimable on their purchases is zero. So the net VAT they collect on behalf of HMRC is £200 minus £0, which is £200. The wholesaler charges 20% VAT on their sales price of £1,500, which equals £300 of VAT they need to collect. But they reclaim £200 of VAT because they purchased the goods for £1,000 from the manufacturer. So the net amount they collect and pay to HMRC is 300 minus 200, which equals £100. The retailer sells the goods to the consumer for £2,000, so the amount of VAT they need to collect is 2,000 times 20%, which equals £400. But they also reclaim VAT on their purchases of £300, which is equal to the £1,500 purchases they made, times 20%, and that leaves a net amount collected on behalf of HMRC of £400 minus £300 equals £100. So what's the result of all this? Well, each business pays VAT only on the value that they've added in the supply chain. So in total, HMRC receives VAT of £200, which is collected by the manufacturer, £100 collected by the wholesaler, and £100 collected by the retailer. So the total VAT that's been collected is £400, and that is ultimately borne by the consumer. So that's also equal to the VAT charged on the final sale to the consumer. Everyone else in the supply chain is recovering the VAT that they paid, so it's the end consumer who's ultimately bearing the £400 tax charge. So again, let's summarise the VAT movement through the supply chain. The manufacturer collects £200 for HMRC, the wholesaler collects £100, and the retailer collects £100. Together they've passed on £400 of VAT to HMRC, but that's not at a cost to themselves. Each has reclaimed VAT on their purchases, so it's the consumer who's ultimately paying the £400 VAT bill when they make the final purchase of the good from the retailer, because the consumer is unable to reclaim this tax charge from HMRC. That's why we say the consumer bears the cost and the businesses simply collect and transfer the VAT on behalf of HMRC. And again, while HMRC receives £400 in total, the amount is collected in stages, with each business only passing on the VAT amount related to the value that they've actually added during the process. So that's why we call it the value added tax. So to summarise, the producers and suppliers pass on the £400 of tax to HMRC, but it actually isn't costing them anything. The entire £400 is coming out of the pocket of the end consumer. Cool, let's now look at how VAT is recorded using journal entries for 4 key types of transactions. We have both sale and purchase transactions, both made on cash or credit terms. So let's start by looking at a cash sale of £1,000, subject to 20% VAT. So the total amount received from the customer is £1,200. That's £1,000 for the goods plus £200 worth of VAT. So to record that, we debit cash £1,200. We credit revenue of £1,000, which is the amount the business actually earns. That's the amount that's going to flow through their income statement. And we also need to credit the VAT payable account by £200 because the business needs to reflect the fact that it owes HMRC £200. So we credit the VAT payable account. So what we're saying here is that £1,200 of cash that they're debiting isn't all revenue. £1,000 of that is revenue, but £200 of that is VAT that they owe to HMRC. Next, let's look at a credit sale for exactly the same amount. So the mechanics are pretty identical here, but instead of receiving cash, the business debits receivables by £1,200. We credit 1,000 again, and we also credit VAT payable of £200. So the structure is exactly the same. We're just reflecting different timings of cash flow. If it's a cash sale, we debit cash. If it's a credit sale, we debit receivables. Cool, now we've looked at sale transactions, let's turn to purchase transactions. If the business makes a cash purchase of £5,000 at a VAT rate of 5%, it's only paying £5,250 in total. So in this case, we debit purchases of £5,000 to reflect the purchase that has been made in the income statement. And we also need to debit the VAT owed. This is actually the amount that's owed to the business by HMRC. Because they made a purchase, they can recover some of that VAT from HMRC, hence why it's a debit to the business. That's value owed to the company. And of course we credit the cash amount of £5,250. So the same treatment applies to credit purchases, but instead of crediting cash, we need to create a payable. So we're debiting our purchases of £5,000. We're again debiting our VAT owed of £250, and we're crediting trade payables of £5,250. So once a business gets to the end of their reporting period and all VAT entries are accounted for, they can calculate their net VAT position. So if the business has paid more VAT to HMRC on purchases than it's collected on sales, then it's owed money by HMRC. That would be recorded in the statement of financial position as an other receivable. On the other hand, if the business owes HMRC more VAT than it can reclaim, then the balance would appear on the balance sheet as a liability. That would be included as other payables. So in many real-world accounting scenarios, you'll be given a total amount that includes VAT, and this is called the gross amount. And from that, you'll need to break it down to find the portion that actually belongs to the business and the portion that needs to go to HMRC. So this slide shows you exactly how you do that. So let's start on the left. If you're given a gross amount, say that you're given total sales including VAT, there are 2 quick calculations you can use to calculate the net amount. So to find net sales, that's the amount that actually goes into the pocket of the business. You multiply the gross amount by 1 divided by 1 plus the VAT rate. So for example, at the standard rate of VAT of 20%, you'll take the gross sales amount and divide it by 1 plus 20%. To find the VAT amount, which is the portion of the sale the business is collecting on behalf of HMRC, you take the gross sales amount and you multiply that by VAT and you divide by 1 plus VAT. So at 20%, you take the gross sales amount and you multiply that by 20% and divide it by 120%. Now let's look at a worked example on the right hand side, which will hopefully bring this concept to life. So we're told that a business generates sales of £1,200, that's our gross sales amount, and we're also told that a standard VAT rate of 20% applies. So to calculate net sales, all we do is take £1,200 and multiply by 1/1 plus 20%. It's our standard VAT rate, which gives us net sales of £1,000. That's the amount the business actually earns in the period, and that's the amount that will be reported by the business as revenue on their income statement. To calculate the VAT amount, we could either subtract £1,000 from the £1,200, or we can use the shortcut formula where we take the gross amount, we multiply by the VAT rate of 20%, and we divide by 1 plus the VAT rate of 1 plus 20%, which equals £200. So that £200 is the portion of the sale that belongs to HMRC. So to summarise, from a gross sale amount of £1,200, the business actually only receives £1,000 worth of revenue, and the remaining £200 is VAT, which is the tax that the business needs to pass on to HMRC. So this breakdown is really crucial for correctly preparing VAT returns and also for accurate financial statement reporting. Okay, let's take a closer look now at how we account for VAT by going through a sample exam question. So in this example, we're told that the business purchases goods for £4,000, excluding VAT, and pays for them immediately in cash. So since the VAT rate is 20%, we first need to calculate the VAT on top of the net purchase amount. So 20% of £4,000 equals £800. That's our VAT. And that brings our total cash payment made for the purchase equal to 4,000 plus 800, £4,800. Now let's think about the journal entry. So the business paid £4,800 in total, so we need to credit cash £4,800. The goods that were purchased were worth £4,000 excluding VAT, so we need to debit the purchases account by 4,000, and because the VAT is reclaimable from HMRC, we also debit the VAT account by £800. So the full journal entry is debit purchases 4,000, debit VAT 800, credit cash £4,800. So this entry ensures that the business's books reflect the actual cost of the goods, the amounts reclaimable from HMRC, and the cash that's gone out of the business. So cool, that's everything I wanted to run through in this video. That's VAT in a nutshell. Any questions, feel free to fire them off in the comments, and I'll see you guys in the next video.